McGraw-Hill Professional presents Stocks for the Long Run, the definitive guide to financial market returns and long-term investment strategies, 5th edition. Written by Jeremy J. Siegel. Russell E. Palmer, Professor of Finance, the Wharton School, University of Pennsylvania. Narrated by Scott R. Pollak. Foreword. In July 1997, I called Peter Bernstein and said I was going to be in New York and would love to lunch with him. I had an ulterior motive. I greatly enjoyed his book, Capital Ideas, The Improbable Origins of Modern Wall Street, and The Journal of Portfolio Management, which he founded and edited. I hoped there might be a slim chance he would consent to write the preface to the 2nd edition of Stocks for the Long Run. His secretary set up a date at one of his favorite restaurants, Circus, on the Upper East Side. He arrived with his wife, Barbara, and a copy of the 1st edition of my book tucked under his arm. As he approached, he asked if I would sign it. I said of course, and responded that I would be honored if he wrote a foreword to the 2nd edition. He smiled. "Of course," he exclaimed. The next hour was filled with the most fascinating conversation about publishing, academic and professional trends in finance, and even what we liked best about Philly and New York. I thought back to our lunch when I learned in June 2009 that he had passed away at the age of 90. In the 12 years since our first meeting, Peter had been more productive than ever, writing 3 more books, including his most popular, The Remarkable Story of Risk. Despite the incredible pace he maintained, he always found time to update the preface of my book through the next 2 editions. As I read through his words in the 4th edition, I found that his insights into the frustrations and rewards of being a long-term investor are as relevant today as they were when he first penned them nearly 2 decades ago. I can think of no better way to honor Peter than to repeat his wisdom here. Some people find the process of assembling data to be a deadly bore. Others view it as a challenge. Jeremy Siegel has turned it into an art form. You can only admire the scope, lucidity, and sheer delight with which Professor Siegel serves up the evidence to support his case for investing in stocks for the long run. But this book is far more than its title suggests. You will learn a lot of economic theory along the way, garnished with a fascinating history of both the capital markets and the U.S. economy. By using history to maximum effect, Professor Siegel gives the numbers a life and meaning they would never enjoy in a less compelling setting. Moreover, he boldly does battle with all historical episodes that could contradict his thesis and emerges victorious. And this includes the crazy years of the 1990s. With this 4th edition, Jeremy Siegel has continued on his merry and remarkable way in producing works of great value about how best to invest in the stock market. His editions on behavioral finance, globalization, and exchange-traded funds have enriched the original material with fresh insights into important issues. Revisions throughout the book have added valuable factual material and powerful new arguments to make his case for stocks for the long run. Whether you are a beginner at investing or an old pro, you will learn a lot from reading this book. Jeremy Siegel is never shy, and his arguments in this new edition demonstrate he is as bold as ever. The most interesting feature of the whole book is his twin conclusions of good news and bad news. First, today's globalized world warrants higher average price-earnings ratios than in the past. But higher PEs are a mixed blessing, for they would mean average returns in the future are going to be lower than they were in the past. I am not going to take issue with the forecast embodied in this viewpoint, but similar cases could have been made in other environments of the past, tragic environments as well as happy ones. One of the great lessons of history proclaims that no economic environment survives the long run. We have no sense at all of what kinds of problems or victories lie in the distant future, say 20 years or more from now, and what influence those forces will have on appropriate price-earnings ratios. That's all right. Professor Siegel's most important observation about the future goes beyond his controversial forecast of higher average PEs and lower realized returns. Although
Sample complete. Ready to continue?